The most dangerous taxes in a society are rarely the ones that arrive with a trumpet. They arrive with softer language, fairness, adjustment, assessment, surtax, modernization, closing loopholes, supporting schools, helping housing, protecting communities. By the time the public understands what changed, the system has already learned a new habit. And once a system learns a new habit, it rarely forgets it. That is why I want to speak plainly about something that homeowners, savers, and high earners alike keep misunderstanding. The real issue is not whether there is already a nationwide tax on your home equity in the blunt, cartoonish form some headlines suggest. There is not. The real issue is whether the political and administrative logic needed to justify taxing more than income is already spreading. It is. And if you own a home, especially in a high-tax state with a large embedded gain, then you are much closer to that conversation than you probably think. Now, let us begin with the difference between a silly headline and a serious trend. A silly headline says they are about to add a new equity tax to your property tax bill tomorrow morning. A serious trend says something much more useful. Governments at every level are becoming more comfortable taxing success through layers instead of through one obvious door. Higher income surtaxes, capital gains taxes, mansion taxes, transfer taxes, assessment increases, annual reassessment systems, proposals for wealth taxes, proposals for taxes that pull unrealized gains into the tax base for the very wealthy. That is the actual pattern. And patterns matter more than slogans. Massachusetts is a clean example of the first stage. Voters approved the Fair Share Amendment in 2022, adding a 4% surtax on taxable income over $1 million. And that surtax is now part of the state's constitutional framework. Washington did not create a broad millionaire income tax, but it did adopt a state capital gains excise tax, with a higher tier now applying above $1 million of taxable Washington capital gains. California does have a live billionaire tax initiative in circulation for the November 2026 ballot cycle, but the official analysis says it is a one-time tax on billionaires and explicitly excludes real estate, pensions, and retirement accounts. At the federal level, Elizabeth Warren and her allies reintroduced the Ultra-Millionaire Tax Act in March 2026. While Treasury's own published budget materials have separately discussed a 25% minimum tax on total income for people over $100 million in wealth, generally inclusive of unrealized gains. None of those items is the same as a direct nationwide home equity tax, but together they tell you something important. The political imagination has moved well beyond ordinary wage income. Face site Fay turn 645,145 search 0, Fay turn 645,145 search 3, Fay turn 645,145 search 1, Fay turn 645,145 search 12, Fay turn 838,296 search 2, Fay turn 838,296 search 0, Fay turn 838,296 search 1, Fay turn 838,296 search 1, Fay. First thing I need you to see. Clearly, the people selling fear want you to think in absolutes. Either there is already a law taxing your equity directly, or there is nothing to worry about. Intelligent investors should reject that entire frame. The real question is this: how much infrastructure already exists to identify value and target unrealized housing wealth indirectly or eventually more directly? The answer is quite a lot. Your county already has an opinion about what your property is worth. In some places, that opinion is conservative. In other places, it is ambitious. In almost all places, it is operational. California's Proposition 13 system still matters enormously because it generally limits annual increases in assessed value to 2% unless a change in ownership or new construction resets the base. Florida's Save Our Homes benefit generally limits assessed value increases on a homesteaded property to 3% or CPI, whichever is lower. Texas homesteads have their own limitation, with appraised value increases generally capped at 10% per year for qualified homeowners. These are not theoretical protections. They are live structural differences in how quickly taxable value can climb. And that means they directly shape how much of your home's appreciation the tax system can reach each year. Face site Fay turn 931,675 search 4. Fay turn 548,994 search 10. Fay turn 931,675 search 1 Fay. That matters. Because a homeowner's vulnerability is not just about whether a legislature invents some new line called equity tax. It is also about how fast the taxable value underneath him can be updated, how often, with what caps, under what exemptions, and through what legal ownership structure. This is where average people make a very expensive mistake. They believe a property tax bill is simply a bill. I see it as a measurement system. Every time the assessor updates value, the state is learning something useful about you, not just what you own, what your ownership has become worth. And if policymakers become more aggressive in targeting accumulated wealth rather than only annual income, that data foundation is already sitting there waiting to be used. That is why I do not dismiss the broader concern, just because the loudest version of it is overstated. The loudest version says your county is definitely about to add a home equity line item. The smarter version says your county, state, and federal system are all getting more comfortable with wealth visibility, more comfortable with taxing different layers of financial success, and more capable of identifying who has appreciated assets and where those assets sit. That is enough to justify preparation. Now, let me tell you what I think is actually happening politically, because this is the part almost nobody says cleanly. The problem for governments is not that they cannot find tax bases. The problem is that they are running out of socially painless ones. They can keep pushing on wage income, but voters feel that quickly they can push on sales taxes. But voters feel that at the register, they can push on corporate taxes, but eventually some of that shows up in prices, wages, hiring, or capital flight. Property is different. Property sits there. It is visible. It feels rich. Even when the owner is not liquid, it is local. It is accessible. It is emotionally easy to target because politicians can always find a villainous frame around houses that appreciated too much. That is the danger. Not that your primary residence is suddenly being seized, that the language of fairness drifts from income to accumulated value, then from accumulated value to unrealized appreciation, then from unrealized appreciation to home equity. You should not need the last step to happen before you start thinking. Now, let me be even more direct, because some people still hear this and say, this is just for billionaires. That is exactly how these things usually begin. They begin where the public feels least sympathy. Billionaires, ultramillionaires, mansion buyers, hedge fund managers, people with more than anyone thinks is morally necessary. That is stage one, because it is politically easy. Stage two is where the logic gets normalized. Once you convince the public that unrealized or accumulated wealth can legitimately be part of a tax conversation, you have already crossed the difficult philosophical bridge. After that, the fight is usually not about principle anymore. It is about thresholds, exemptions, caps, carve-outs, and definitions. That is when ordinary affluent homeowners should start paying very close attention, because the number that makes you safe today is often just the number they have not lowered yet. Now let us talk about the house itself, because this is where things become real. A house creates at least 4 separate tax conversations. The first is the standard property tax conversation, based on assessed value and millage or rates. The second is the transfer conversation, when you buy or sell. The third is the gain recognition conversation, if you sell and realize a profit. The fourth is the embedded equity conversation, which may not yet be taxed directly in your jurisdiction, but is increasingly visible and increasingly tempting to governments hungry for revenue. Most homeowners only think about the first one, occasionally the third, and almost never the fourth. That is why they sleepwalk into exposure. If your house has grown enormously in value, and if that value is sitting in your personal name in a jurisdiction that already likes tax creativity, then you are standing in a spotlight whether you enjoy it or not. That does not mean panic, it means structure. I want to say that word again because it is the entire lesson. Structure: the poor think about prices. The middle class thinks about payments. The wealthy learn to think about structure. Who owns the asset? Under what title? In which state? With which exemptions? With which domicile record? With what debt attached? With what assessment history? With what trust, LLC, or family office wrapper? You do not need secrecy theater. You need lawful structure that matches the reality of your life. Now let me be careful here because this is where amateurs and grifters start talking too fast. Putting property into a trust or LLC does not magically erase tax obligations. It does not guarantee invisibility. It does not immunize you from a future law. And if you play games with residence or ownership without respecting how your state actually audits domicile, you can make your life much worse. California in particular has a reputation for aggressive residency and sourcing enforcement, and states do not need your press release saying you moved. They look at your pattern of life, records, and facts. That is why serious domicile planning is a real thing, and costume relocation is not. Face site Fayturn 548,994 search 0, Fayturn 548,994 search 4 face. Oh no, I am not telling you to slap a trust on the deed and declare victory. I am telling you to stop holding meaningful assets in your name by habit alone. Habit is not a legal strategy. Now let us talk about another unpleasant truth. A fully paid off home is emotionally satisfying and politically exposed. I know that sentence will upset some people because our culture treats a paid-off house almost as a moral crown. And I understand that there is peace in having no mortgage. There is dignity in owning the roof over your head outright. There is a deep psychological benefit to simplicity. But simplicity and invisibility are not the same thing. A home with a large amount of naked equity is a very easy thing for a system to notice, assess, and envy. Again, that does not mean everybody should immediately lever up their house and borrow against it recklessly. That would be idiotic. It means the structure of your balance sheet matters. Some homeowners sit with a giant visible pile of low productivity home equity and no real plan for what that equity is doing for them besides making them feel safe. Other homeowners keep cheap fixed debt in place, protect liquidity, and deploy capital into other productive assets. Those are radically different positions, even if both families live in a house worth the same amount. One family is living inside emotional accounting, the other is managing a balance sheet. That is a better way to think. And before anybody misunderstands me, I am not saying home equity debt is automatically clever. If your only use of extracted equity is lifestyle expansion, then you are converting optionality into appetite. That is not smart. But if your house is a giant reservoir of visible wealth, and the policy world around you is becoming more hostile to visible idle wealth, then you should at least understand the strategic difference between encumbered capital and naked capital. One is easier for the system to point at. Now let us turn to the assessed value itself, because this is the most boring part of the conversation, and therefore one of the most important. Governments love unchallenged numbers. If an assessor values your property too high and you simply pay the bill without protest, that number hardens. It becomes not merely an estimate, but an accepted estimate. The more often that happens, the more administratively real it becomes. If future tax policy ever leans more heavily on assessed or taxable value, the groundwork has already been laid by your own passivity. That is why appeals matter. That is why exemptions matter. That is why homestead status matters. That is why Prop 13 in California, Save Our Homes in Florida, and cap rules in Texas matter. These are not merely little discounts. They are rate limiters on how fast your visible taxable wealth can be rewritten upward by the system. The adult homeowner checks them. The lazy homeowner assumes they are active forever. The expensive surprise usually belongs to the lazy one. Now, let me go one level deeper. Because there is another reason this conversation is important, even if you live in a state that has not yet gone particularly creative on taxation. Ideas migrate. That is one of the most important facts in politics. A state experiments. An advocacy group writes a paper. A senator writes a bill. A ballot initiative gains a title and summary. A Treasury Department publishes a framework. An academic argument becomes a tank proposal. A tank proposal becomes a campaign phrase. A campaign phrase becomes a plank. A plank becomes a budget patch. That is how new tax ideas normalize. Slowly, then suddenly. The average citizen waits for final passage before paying attention. By then, he is already late. The prepared citizen studies direction, not just destination, and the direction here is obvious enough for me. Wealth visibility is rising. Tolerance for taxing more than annual labor income is rising in some parts of the political system. Property data's increasingly refined assessment systems are entrenched, and the moral language used to justify taking a larger share of accumulated private value is becoming more sophisticated and more familiar to voters. That is enough to justify title review, enough to justify domicile review, enough to justify checking your assessment, enough to justify confirming every exemption is active, enough to justify understanding whether the way you hold property today is merely convenient or actually intelligent. Now, because I dislike fear without a framework, let me reduce all of this to a set of sane actions. First, know exactly which tax regime you actually live under. Not the one your cousin argues about online, your real one. Your state, your county, your assessor, your domicile standard, your homestead rules, your reassessment triggers. Second, know how your property is titled and why. If the answer is because that is just how we bought it 15 years ago, that is not a reason. It is a confession. Third, verify every exemption and cap that should be protecting you. California Prop 13 protections. Florida Homestead and Save Our Homes Texas Homestead cap. Whatever applies where you live, confirm it with the seriousness you would bring to an audit. Fourth, challenge bad numbers. The government's first number is often not sacred. It is simply the first number fifth. Do not pretend moving is the same thing as relocating in law. A real move changes facts, not social media bios. Sixth, think about home equity as part of a total balance sheet, not as a spiritual achievement. A house can be a home and still be a financial structure. Mature people can hold both ideas at once. And finally, stop laughing at rich people problems when those problems are really early warning signals for future policy logic that may drift towards you later. The wealthy often move first, not because they are always morally better, but because they see the structure sooner. I would rather you see it early than complain about it late. So, no, I am not telling you they have already added a direct equity tax to your property tax bill. I am telling you something more useful. The line between taxing income and taxing owned value is politically thinner than it used to be. The line between a property tax system and a broader wealth visibility system is thinner than most homeowners think. And the line between lawful preparation and very expensive passivity is thinner than all of it. That is why I would act now, not dramatically, but intelligently. Review the title, review the domicile, review the exemptions, review the assessment, review the structure, because the people who lose most to a changing tax landscape are rarely the ones who broke the rules. They are usually the ones who never noticed the rules had changed shape around them